Hey friends, so today is going to be a quick and simplified video on financial modeling. So let's get straight into it. Let me just share the screen. So the reason why I created this financial modeling video is because Mr. Vikram is asking that thank you for providing the great knowledge. Can you please give us more information about financial modeling and accounting knowledge and investment vehicles? So these three are all different vast topics. I don't want to make this video very long. So this one is going to cover about financial modeling. Okay. And then who are all the beneficiaries here? Quick learners who don't have too much time. It's just barely like 10 minutes, 15 minutes, that's it, okay? And then interview attendees who are going for interview, this will be very useful for them. Financial students, accounting students, introduction to data models who have no idea about data models, this will be helpful. IT and data modeling students, and also introduction to financial models. People who don't have any idea about financial models, this video will be very helpful. Why we need financial models? Okay, so before we talk about financial models, we need to know what is a data model, because financial model is a type of data model. So data models are standardized method for formatting database contents to turn complex organizational data into usable computer systems, right? This is a standardized method for formatting database contents to turn complex organizational data into simple ones. Let's go with the example, customer. So the customer table will have all the information about customer name, customer address, customer preferences, customer contact information, everything will be there, right? So this customer is called the attribute, sorry, the entity. Each of these tables are called, another name for this is the entity. And the fields within the entity is called the attribute. So we have two new keywords here. One is entities and attributes. You need to be familiar. Attributes is another name for column, and entity is another name for table. As simple as that. So what does the data model do? It is a standardized method for formatting database contents to turn complex organizational data into usable computer systems. Product, income, balance, account, everything is a entity. Every data that is captured is an entity, and attributes, columns within an entity, give more details, or the entity, the attributes are otherwise called properties. So an entity has columns, which is otherwise the attributes, otherwise the properties. Because let's say we take a customer and the column is customer name. So the customer name is an attribute. It's also a property of the customer, right? So that's how it is. So once we are, now let's get into the next one. After we covered data model, now we want to know what is a financial model. Financial model shows predictions about the future financial performance of a company. So it predicts the future. How can it predict the future? Based on historic data. It's used to anticipate the future, raise investments, and look at new opportunities. So why are we anticipating the future? To raise investments and also to look at new opportunities. It can analyze historical data for the last 3 or 5 years and make forecast assumptions for the future, right? So let's take an example of here to buy a stock. Now, to buy a stock for a particular company, Apple, let's say, so for all the information about Apple, like income statement, balance sheet, cash flow, these are all already out there, and other data you need to make predictions about the future performance of the stock, for example, Apple, it's already out there. So we are using that information to predict the future. That is called financial models. Second one is acquiring a retail company, right? Let's say, for example, a company that is selling biryani, or a company that is selling samosa, or now you have the income and expenses, right? What is your income? Income is what you get from the customer. And what is your expense? Everything, the raw materials that you're buying, the shop that you're renting, that all coming under expenses, right? Now we are using this data and creating the income statement, balance sheet, cash flow statement so that we can predict the future to see how that company will perform in the future. Basically, we are making forecast assumptions using the financial data to better predict the future. That's what the financial model is all about, to better predict the future based on the historical data for 3 years or 5 years or even 2 years, right? We will get into examples later on, but now the last point here is three statement financial model. So gives us an idea about how the three financial statements interact. What are the three financial statements? Income statement, cash flow statement, and balance sheet. We will discuss each of the examples. So let's get into the next slide. The next one is what makes a good financial model. Before we discuss in detail about three statement financial model, we want to understand what makes a good financial model. Focus on key cash flow drivers, because for any business, cash flow is the king, right? Without cash flow, there is no. If you're looking at a rental unit, you want to make sure that after paying your mortgage and expense and everything, there is a cash flow. If you're just looking at biryani business or samosa business or whatever you want, there should be a cash flow. Without cash flow, the business will die, right? That's why a good financial model always focus on key cash flow drivers. Second one is it should be simple, because what is the basic idea about data models or financial models is like we are simplifying the complex organizational or enterprise structures into simple modules, right? That's why it should be relatively simple. Everyone should be able to understand. Third one is evaluate the risk, because if you're not evaluating risk, then we will not be able to mitigate the risk. So we need to capture the risk and evaluate it. That is the third point for a good financial model. The last one is clearly convey assumptions and conclusions. So we need to clearly convey assumptions and conclusions, right? That is very important. So this could be just an interview question, like so anyone could ask you like what makes a good financial model, right? Now the final step here is how to make a financial model. We covered what and why, and now it's a how, right? So we are going back to the three statement financial model. In the three statement financial model, we have something called income statement, and it's also called profit and loss statements. Another term is the profit and loss statement. So what does this statement have? Sales minus cost equal to profit or loss, which is what basically this income statement or profit and loss. In the income statement, we are talking about total revenue, gross profit, operating income, pre-tax income, and finally we come to the net income. That will be the profit or loss. So the income statement is covered. Let's now get into balance sheet. What is there in balance sheet? We take into account assets like land, building, office equipments, inventory, everything. And then we also take into account liabilities like bank loan, account payables. These are all considered in the balance sheet. And also then we take into account equity, that is paid in capital, retained earnings, already the earnings or the capital that is already with the company, that is the equity. These three are considered for balance sheet, right? And then if you want to get to details, it's all here. You can take a snapshot, or if you email me, I can send this to you. So let's get to the next one. The final one is we have what is called statement of cash flow statement. So what is there in cash flow statement? Net cash flow formula is equal to total cash inflow minus total cash outflow. That is cash flow statement. And here you can see we are considering everything, we are factoring in everything so that we get the actual cash flow, right? So the third statement is cash flow statement. Now let's look at an example for a three statement financial model, right? So what we do here is we take all the statements that we discussed into consideration. We get the data for first year, we get the data for second year, and we predict the data for the third year and the fourth year using the historical data. So here growth percentage is 42%. Now it is again 42%. Third year it will be 42% or more, like based on other numbers, right? That is what the entire concept of financial modeling is all about. And then we are predicting the fourth year, and then we are predicting the fifth year, right? So this is an example of how the financial model will actually look like. Now, we discussed in detail about a three-statement financial model, but to complete the discussion, we also need to cover what are the other important financial models that usually in the market, that is in demand, like people are using across different enterprises. The first one is discounted cash flow financial model, right? And DCF, it's called DCF. The next one is comparable financial model. Otherwise, also it's called COMS. And another one is leveraged buyout financial model. It's called LBO financial model. And also we have the M&A financial model, which is the mergers and acquisition financial models. So these are all different financial models that is used based on the requirement, right? So this is a basic summarized capsule in simplified way about financial models. Hope this video was helpful for you. If you are confused about any particular topic that was discussed, please shoot me an email or rewatch the video. And I enjoyed creating this video. Please subscribe so that I have the motivation to create more simplified, useful videos like this.